Well, good afternoon. Good afternoon, and welcome to yet another Webinar Wednesday hosted by Cal State Bakersfield Small Business Development Center. This is Webinar Wednesday number 378 on April the 29th, 2026. Good afternoon. I'm Kelly Bearden. I'm your host today and your webinar director, your SBDC director. So I think we got a good one today. A lot of unique ways to fund businesses. I always believe that there's a lot of different creative ways to fund businesses. And we're going to look at a number of those today, beyond six. So I've got a special guest we'll bring in here in a minute and talk about reinforcing one of those. But first, and coming up next week on Webinar Wednesday will be May 6th. It'll be our U.S. Small Business Week celebration. And we'll have our special guest, Don Golick, the district director of the Fresno SBDC SBA district. And we're going to have much more to share with you that day. So next week, big celebration, U.S. Small Business Weeks. Let's celebrate. So let's get to today. Today is April the 29th, 2026. And we're going to be talking about opportunity and a way to fund your small business. Our Capital Quarter, our regularly scheduled feature, is going to have a lot of different options available today. We like to say we have good options, we have bad options, and we have some that are not so pretty, but there are options. And the great thing about so many of these different options is they're going to pertain to so many different users. So they might pertain to you, and they might not, depending on your type of business. It's the great thing about business is that depending on the size of the amount you need to borrow or you need to fund, and also a variety of other factors, there's so many different programs that can actually come into play. So we'll be talking about a lot of different options today. We'll have a little brief economic corner. There's some very interesting, I thought, consumer data that came out and a couple of other things on the economy that you need to keep an eye on and you need to know about. So we'll touch on that briefly. Our third regular feature is AI and question mark. And so this time we'll make sure that our AI and question mark stays true to today's topic, which is unique alternative funding. And more on that in a little bit. Our community calendar highlights, and we'll also take answers to your questions or give you answers to your questions after today's presentation. So if you have a question, you can go into the Q&A box, which is located, I believe, behind where it says more, or you can actually add those into the chat. And we're working our chat box today will be our webinar producer, Maureen Busher-Dang, and she will be there today. And so she'll have plenty of resources that she adds as we go along today. And who knows, sometimes, on April the 29th, the day we all call Fence Day around here, it is time to have a poll rather than not have a poll. So let's do that. Let's find out a little bit about some of the individual choices out there and some of the things that you can help us with today's presentation. So our first question, our first poll question is going to be this one. It's going to be, what is your biggest barrier to funding? So what is your biggest barrier? One single answer? Are you looking to find investors? Is that a problem? Is it finding and understanding programs? Is it the loan qualifications that sometimes is your biggest barrier? Is it being able to understand your numbers and show and project your financial growth of your business? Or is it some other reason? And like always, if you have another, throw it in the chat. We'll get back to it sometime today. I don't know when, but sometime you usually circle back to those. So what we're doing is we're looking today's poll question number one of three is, what is your biggest barrier to funding? So we do have already 58% of you have already answered and participated. Thank you so much. And of course, we're looking to see if your biggest barrier is finding investors. Is it the loan qualifications? Is it finding the right program and understanding programs or projecting financial growth? So with 69% of you participating, let's end the first poll question and share the results with you. And those results show that half of you, it's qualifying for a loan is your biggest problem. It's the loan qualifications that are up there. So we're going to go through some of those issues today with loan qualifications, because I like to think that that is a moving curve. And the fact that you don't qualify today doesn't mean that you won't qualify 6 months from now or even 3 months from now. So loan qualifications, number two is finding and understanding programs. So we'll go through a lot of these. You'll find a lot of them today and hopefully gain a better knowledge of some of those that are out there and could be opportunities for you to fund your business. And then only 6% of you with the projecting financial growth. So thank you for the first question. Let's go to poll question number two. And poll question number two is going to be, in the past, how have you funded your business? So in the past, have you used personal savings? Have you used credit cards, some other alternative funding, family and friends, or if it's another, you can put it into the chat box. So how have you funded your business? Personal savings, credit cards, alternatives, friends, family, others, etc. And we're up to 75% of you. Look at you go. 75%. One last chance to get into this poll, and we'll end it and share the results with you. With 75% of you reporting, 61% have self-funded your business. 61%, not uncommon at all. No matter how big your business grows into, it seems like it always starts with your personal investment. So 61% of you are there. 22% of you have used credit cards, while a last three-way tie between alternative funding, friends and family, and another resource. So thank you for poll question number two. And our final poll of today is going to be this one right here. I think I've done sharing that poll. So let's go to poll question number three, and it doesn't really want to launch. Dang, it's my best one. It always works that way, doesn't it? So poll question number three is giving me a little bit of issues, but I'm stubborn, as you know. I'm going to give it one last chance to get this poll question going. So here, we'll give it one last shot. Poll question number three, where are you? And you're not watching. So that was going to be my favorite, of course, because it was going to ask, what is your ideal funding request? You know, because I like to think of when I meet with a client, I like to ask, what is your idea? How much do you want? So your want, and then I also like to come back with how much do you need? So under ideal situations, how much money do you need? And then how much would it take to potentially still make the business a success, but make it easier to fund? But we'll never know. So hold on to that one. We'll get that one another time. Okay, moving along, we'll get our economic corner out of the way. And there was an interesting work that was done, an interesting slide that I saw this last week in the local newspaper, and maybe it was the Wall Street Journal, it was somewhere. But it was basically, it showed where consumer spending and prices were coming into alignment. So where were Americans willing to pay for items, and what were they reflecting as far as price increases over the last year? And I found it quite fascinating because it probably aligned with a lot of my thinking as well. But what it did was it also kind of showed a couple of things. For example, items such as phones, for example, that have shown a price decrease have been very popular. Durable goods also. So where we see where pricing has been softer or gone down, we have seen consumer demand remain strong in those particular areas. The two weakest ones on the board we'll show you is going to be tableware and then audio visual equipment, which have both shown substantial increases over 30% in pricing and has shown dramatic, and not quite that much, but between 20 and 25% decreases in demand or sales. So kind of seeing that going along. And so the pricing and customer alignment, and really, it's still the consumers who are still kind of driving this economy. So on the economic side of things, kind of interesting. Another interesting topic floating around is a credit bubble coming. And basically, they're saying because of the large delinquencies or the large number of people with student loans that are not repaying, and also some of the mortgage loans, is there a potential credit bubble coming from those particular two sources? So when I see the student loan aspect of it, it reminds me of one of the questions and one of the qualifications that turn us into talking about alternative funding. And that is going to be basically if you have ever defaulted on any federal loan anytime during probably the last 20 years, then you're not going to be able to use SBA funding. That is government rules and regulations that have come down. And really, the one that's really getting a little sticky that we're seeing is we have really solid applicants who are wanting to get SBA funding or some type of bank funding and are unable to take advantage because of that student loan issue. So just wanted to make you aware of that as we move forward from that. And that's pretty much going to be our economic corner for today. Today, not our special guest as he's been in the past, but we're going to do a live look in. We're going to talk a few minutes about one of the alternative funding sources that we really like at the SBDC, and really kind of show you basically, a lot of the options and how it can be used, being tremendously underutilized. So what I'm going to do is I am going to bring in our uh, Eastern Sierra business consultant, Jim Thomsen, who has done a lot of work in the recreation and outdoor business. If you kind of glance at that, he's done some fantastic things over his lifetime, including starting and going public with the first outdoor recreation business in the US. So a lot of different things, but one of the things that he has done is he's done about, I think he's on his third Kickstarter, and we're going to bring him in and show you what he is doing right now with the campaign that's going on right at this particular point. So Jim, thank you for joining us today, and take it away.
Okay, always fun to be here. And some of you may have heard other times when I've been on the webinar talking about crowdfunding. And the previous one I did was about 5 years ago, and we always talked about that. But I hadn't done anything recently, and Kelly and I were talking about it, and we actually are working jointly. And I put out a crowdfunding for a nonprofit that I run, and it launched on Tuesday. So this is the second day of the crowdfunding. So it was really fun to see the changes that have happened to crowdfunding in the 5 years since I did the previous one. This one is sort of different because it's not really a product that you can buy. The number one thing that sells on crowdfunding, especially with Kickstarter and those, is to actually create a product where somebody is going to make a pledge for you and they get the product as a reward for doing it. And that's the easiest way because somebody has the physical item they're going to get. We're running a film festival, which, some people will be able to come and see, but other ones, you're not really getting anything. They will get a t-shirt, they'll get hats, they're getting that sort of thing, but not a physical product that they can really see. So it was a little bit different. And so because of that, we weren't really sure how it was going to work. We did all the things that we've talked about in every other seminar we've run here to make sure that you have different tiers planned out for how much people can pledge and how much what they get for that. Also to make sure that you've done a lot of pre-work and building mailing lists and getting out the word before it actually goes live. And to also make sure that you'll be able to, whatever you promise people, that you'll be able to supply. We're promising t-shirts and hats and posters from the film festival, but you're going to have to ship all those and handle all that for the people who do pledge. So there's a lot of work to put it together. The most, to me, the biggest challenge and time-consuming thing was developing a video. And when we've talked about crowdfunding in general, the videos are critical. Kickstarter says that of successful Kickstarter campaigns, it's like 80% have videos. Very few can do it without a video. The cool thing about it is that the videos that work are not the ones that are the most professionally done. They don't have to be fancy things that you hire somebody to do. The most the most successful ones are just somebody being honest. Where sometimes it's just the people who are creating the product, just talking and filmed on an iPhone, and that's all it is. And those are really good because authenticity is way more important than just having a super professional looking video. And some feeling, I think, when I see some of the ones that are super professional, I figure, they've already got too much money. This is a weird thing they're working on. So we did that using only people that work, that we have for free. We sure didn't hire anybody, and it turned out really good. Now we've got I guess about 24 hours, maybe more than that now, since we launched the Kickstarter, and maybe we can hop to that and take a
Yeah,
look
we're
at that.
trying.
Oh, we're trying, but it's what we came up with is the other thing you have to do with any crowdfunding program, and Kickstarter is one of the, you could say it's more restrictive, but also in some ways I like it. You set it your goal. You have to reach that goal. If you don't reach that goal, you get nothing. So if you say your goal is $10,000 and you raise $9,000, you're not going to get any money at all. So it does put a lot of effort on you to make sure that you'll reach that goal, but it also shows that you have the commitment from either consumers for a product you're planning to make, or that they really like what you're doing. So it's pretty positive. If you look at Facebook's and actually other crowdfunding ones, the other thing that's super critical, well, there's two things that are super critical that when somebody comes and looks at it. One is how many other people are backing it. I mean, nobody wants to back something that nobody else cares about. And the other thing is, how are you doing with your goal right away? And again, I'm guessing on this number, but it's in the 60% range of successful crowdfunding raise about a third of their money in the first 48 hours. So that's what we set this as our goal at, and we're well off to that. The other thing is we set our goal for the first 48 hours of having between 50 and 100 backers. And as I see now on the screen, we have 44 right now. So we're definitely over 30% of our goal.
That's phenomenal. You're in day 2 of this 30-day campaign.
Yeah, it's what we've done is we have a mailing list, but we did most of the push on this with social media, and we have plans. We planned the different social media posts in advance, so we had starting about a week before it launched. We started running them, telling people it was going to happen, and then we did a big one for the launch day, and now we're doing ones that will come out every day. And with social media, you can do a lot of posts. When you think of it, you don't want to overload people, but if you have a normal page and you're not paying for advertising, a post on Facebook only reaches, less than 8% of your followers. So you can do a lot of posts without overlapping. And advertising, Facebook and Meta in general with Instagram is super good at allowing you to define your audience and advertise or put your posts on their feeds directly. So we're doing that, but we're not spending a lot comparatively. I think we've spent total in the pre and then now for the first day, probably less than $300 or so for advertising. So it's not a very expensive thing.
So, Jim, you came to the SBDC, and well, actually, you've been here for quite a while, but we started talking about crowdfunding. We see it as a very viable means. For me, it allows businesses to raise capital, and we're starting to see more service businesses that are being able to take advantage of this, and we're coming up with that. So what we did was we actually put some of our student interns into your project and started tuning them in with AI tools in order to try to come up with a system to make it easier, faster, and more efficient so we can get small businesses crowdfunded. And this is the second day of this project of what we've come up with so far. Overwhelming success for day 2.
The things we learned from just the research on AI, not counting the AI helping us with the project itself, but the research is incredible because Kickstarter has a lot, other people have a lot, but using one of the AI people to go and look at we looked at every film festival that Kickstarter had ever done and what succeeded and what hadn't. We, meaning AI. And that information was great to start with, and what awards that they did when it's not a product. What type of things did people mostly go to if they had, t-shirts and posters? I mean, what thing was their number one goal? And then you set that at the amount, and also what amount is the sweet spot for people to Go for it. So it's a ton of research normally, and this was so much easier than when I did it before, because before I just had to Google stuff over and over and, get a lot of different ideas.
So great rewards, great opportunity for people to jump in and still fund it. It's coming up the last week in June in Yosemite, and just a great project. And it's really everything that we had hoped it would be so far. You have the
Yeah,
crowd, and the
yeah.
crowd is responding. So it's everything that your nonprofit is looking for, as far as the Yosemite Climbing Association. But really, for us, it's really shown us that we can make this easier. We can teach small businesses how to use this to actually help fund their business. And when you get to your goal of 15,000, what would you estimate that the cost of these rewards, as far as t-shirts, hats, and other things, what do you think they're going to cost your organization?
At each level, we took a cost compared to that level's pledge amount. So a $125 pledge would cost us about $30. And that includes, and a $125 pledge included a t-shirt and a hat, both. So we have to print them, produce them, and ship them. We're using all print on demand because we don't have the employees or time to do the work. So we're using outside people. So we have a margin of making about 65 to 70% on each one. But then we're having people come in. We have a $125 limit. I was looking this morning, we've had 3 people go ahead and give us $250 for that $125 limit, because that's how much you have to do minimum. You can put as much as you want on it. And then we have some $500 donations, and those would
Two
make a
so
lot
far.
more. Yeah. So, but our goal,
So overall, would you say it's maybe 12, 15%
I
of
would,
your ask?
I was going to say that we're going to definitely clear over 12,500 at 15,000. If everything, depending on the mix, it could go as high as 13,500.
Well, I know it's a lot of work, and I know any type of capital that we're going to talk about today, getting it is a lot of work. Um, there's some out there that aren't a lot of work, and you pay for those.
And the advantage to this is it forces you to think through your business even more than just a business plan trying to get a loan. It forces you to see if people really believe in your business. So it's a very inexpensive way to do market research too.
And you get zealot customers that just love your product
And
and
then
service.
and you can keep doing it over. Companies do it over and over, and groups do it over. And we'll probably do it over and over with Film Festival in the future with different benefits, because it appears to be working great.
Well, Jim, I'm going to pop in with this. You might not be with us each of the next few weeks, but the next few weeks, I'm going to pop in and see how we're doing here. 45% of the goal on day 2. You have to have 100% of your goal to receive any funding at all. So if you end up a dollar short, you are a day late and a dollar short in receiving nothing. But you're well on your way toward receiving that 15,000. And you also have some stretch goals for when you reach that
Mhm.
amount, to try to stretch that amount up to 20, maybe even up to 25,000.
Right. Yes,
So
absolutely.
great way to fund businesses, great alternative, and hopefully the work that we've done with our student teams will translate into working with more businesses on helping them move on to that next particular level. So Jim, great job. Thanks
Great.
for joining us again
Thank
today.
you.
Keep up the great work. And back to the webinar. Okay, looking forward to seeing how that goes. Day 2. Gee, he's already getting a 55% and he hasn't got my contribution yet. My $25 or whatever.
Oh no, I've got you down for more.
I'm sure you do. I'm sure you do. So let me not share that again. Now that I've learned how to share that, look, I don't want to share anything else. So, that brings us to, our AI in question mark, and it is AI in crowdfunding because it is fundraising made easier. And so, as I mentioned, we do have our expert student teams that are designed to produce results. We worked on this particular project for months, knowing that we could figure out which the AI tools were and what was the easiest way to make this a success. Now, one thing you got to have with crowdfunding, you got to have the crowd. So you got to be able to go after an email list. You got to go after potential customers, newsletters, something. You got to have the crowd. But we've really proven that with AI, well, we've proven so far on day 2, that with a winning results team, you really enhances your chance for success. And that's our AI solutions team right there. The great annual Christmas party. How about that? And our AI advisor, Jay Thomsen, working with one of the 24 states that have students engaged in AI projects. Okay, our capital quarter is our next focus on all the other ways that we're going to talk about of alternative funding today. And our capital quarter is our feature, and it's going to actually talk about a lot of things. The first thing we're going to start with is kind of the problem on why we're talking about alternative funding sources today. And the problem is, declines from SBA and other bank type funding. So if we didn't have those declines, or if we had the capability to access SBA or traditional funding, we wouldn't have the problem. So we're seeing the problem is associated with insufficient capital or your down payment. So lenders are generally going to want to see a down payment, anywhere between 10 and 30%. Let's focus on the 20% number. So they want a 20% down payment. Now, since a lot of these lenders are a little bit subjective, there is some wiggle room in there. And some lenders prefer capital, some prefer collateral, some prefer credit, some or pretty much all prefer consistent, strong cash flow. But really, those are the kind of things that jump in and actually show us why we have declined. So it's not enough down payment, a collateral issue, which is usually for larger dollar projects. So larger dollar projects will have that particular issue come up. And also weak credit, both personal or business. Inconsistent cash flow, but not being able to show repayment. The bank is going to look to see if there's repayment. If not, they're going to decline the loan. There's going to be financial factors in there. If you don't understand your financial numbers, they can decline the loan. Some banks are risk adverse when it comes to startups, but many of those will not take a chance on early stage risk. So early stage new startup businesses, they don't want to fund. They want you to get funding or start up and then come to them. And then the other thing is industry risk, to where you see this in certain industries that might be going on based on our economy, which is kind of why we have our economic corner. So it could be restaurants, construction, and other things that might have more of an industry risk associated with how they're doing business in that industry. So real quick, I want to go over some more of the kind of the problem and what we're looking at. I showed you the map earlier that I'll show again, the 14 county region. Half of those counties are us and the Valley Community SBDC located in Clovis. So the central and southern San Joaquin, along with the eastern Sierra and Sierra Nevada. So you'll see that pretty much right there, that big chunk of real estate. So what we were able to do is we were able to partner on the Federal Reserve survey for 2026. And we needed to partner because we needed to get a sufficient number of applicants in order to create our own data. So in looking at the problem, here we can see how we stand up in that area, that 7-county region, compared to how we stand up against the United States in general. And again, this is a survey that was done by the Federal Reserve Bank. They do it every year, and they supply information to us to use in our planning and a lot of other factors. So what you'll see here is you'll see that throughout the United States, if you go to the second one, 44%, as far as when the respondents were asked what type of funding that they have, most of them, or 44% of them anyway, said a loan, whereas in our area, it was only 20%. And we're also legally additionally deficient in the lines of credit. So that shows an issue that we have. Also smaller amounts of credit. So it's showing that we don't use external funding as much as other areas, which really bring alternatives into play much, much more. So on the dollar amount, which I had hoped to compare, but I had poll issues. You'll see that a lot of our borrowers are looking to start with smaller amounts, 25,000, almost double the national average, and pretty consistent or fairly consistent, except when you get into the larger amounts between $250,000 and $1 million. But kind of shows you that we're kind of skewed to the smaller loan amounts until you get to $1 million, and then we're higher than the average. So it'd have been interesting to see how our audience shaped into that today. So we also look at types of funding that was received over the last 12 months. And consistent with our poll question earlier, funds from the owner is number one. And also other ways of actually receiving it, including, your grants and loans and family and friends. Financing and credit products sought. So here we were asking what the most common responses for what you were trying to fund. And it's fairly consistent, except we had fewer that went after loans and lines of credit, kind of like that received. So it's the same old issue, is that maybe a qualification area in our part of the country. And we're going to work to resolve that. Because again, as I said earlier, right now you might be looking for bank funding, or you might have looked for bank funding 6 months ago. But really, those conditions can improve, and they can improve in your business to make you bankable when you're not bankable either today or a few months past. I liked this one because we had fewer that applied for a loan line or an MCA. Now, the MCA are the merchant credit accounts, which, we refer to around the SBDC as vulture financing. So not venture financing, not venture capital, it's vulture capital, and really goes after really bad terms and extraordinarily high interest rates. And really, we see some businesses that are in a kind of a last case predicament, but others sign on to it not knowing what the interest rates can be because they don't disclose those. And it could be as high as, 70, 80, or even 90%. We've seen higher. One of the tools we use at the SBDC is to try to learn as much about your financial background as we can. And the reason we do that with this 26-page questionnaire is to just kind of have a lot of information. So it's asking the tough questions, but they're going to come up, and they're going to come up with your lender. And if we have the answers before you meet with a particular lender or some of the other options that are available, then we're one step ahead. So the problem is magnified by, national banks. They have a cash flow to debt service. So you've got to have that cash flow, and you've got to hit a particular percentage in order to qualify. And, we look at some of the options now for non-bank qualified funding. And so when we get into some of those, we're starting to look at, okay, if you have a good credit history, no blemishes, score is 680 and above, we might look at credit card financing as low as 8 to 10%. A lot of people don't know that if you're looking for a really small amount, there are lenders locally that will do small loans that are basically, in that 8 to 10% range, maybe a little higher, that work as a line of credit. And that's the beautiful thing. As you continue to have repayment history and work that, it kind of can go up. The next bullet is we're looking at, the type of lender. And if you're a business to business, if you sell to a business, if your business sells to government, but not to customers. If you sell to customers, you're not really applicable to these types of non-bank qualified options. One is going to be invoice financing, where you can receive up to an 80% advancement. We see some good successes coming out of this type of funding. And really, if it's not used and used properly, and it's used for a direction of getting your business into the right location, perfect. Another one is a CDFI, and we'll talk about CDFIs a little bit later. Those are Community Development Financial Institution. They're non-bank lenders usually. But one of those is Lendistry that had a program that would actually do a 30% advancement of your invoice. So we'll talk a little bit about this because I think it is viable for those B2Bs and B2Government type lenders. So one of the things that we also see is we see collateral-based loans or cash injection. So we do see those that do have potential equity take advantage of equity lines of credit in their real estate, and they can do that also from a commercial standpoint. Sometimes it's done in cars and equipment when that is available. Sometimes it injects into hard money loans. And actually, if you have a sufficient down payment and you're talking about acquiring real estate, hard money loans can actually be a viable option. And some of those that we see out there also are going to be 401k and also IRA type deals. And the one thing about the 401k IRA, and that is using your retirement accounts, it's using your retirement account partially. And no one's going to sit here and say, yeah, go use your retirement funds to open up a risky business. But people do it anyway, and people do it more frequently. And there are strategic ways of doing this and avoiding early taxation, early payment withdrawals that you would normally get. And you can basically loan the money to yourself. So there are options in that regard. And again, what you're looking to do there is you're looking to use that, like crowdfunding, we're looking to use that capital to leverage and actually open up other monies. So if you had a lender that your qualification issue with a lender was you didn't have a down payment, if you borrow some of your own 401k money, you're basically injecting that from your own personal savings. So that could at least resolve that particular issue. If you're crowdfunding and you actually pull in $20,000 crowdfunding, you net, say, $17,000 off of that. That is money that can, and we've seen happen, be used to leverage small business financing. So those are a couple things to remember on some of the reasons why business financing fails and how you can turn it into a positive. So I like to use this as my master sheet. And of course, I did struggle and came up with 6 of these, or 6 overall. And, some of these I like and some of them not so much, but I put them out there because we see them and they're used. One of the things that we talk about, and that is a transactional lender. And that is essentially a bank that, in many cases, that will do a small business loan, and they just want to make the loan. So they're just there for the transaction. So when they're just there for the transaction, what they're doing is they are there to do that particular loan. Now, many lenders, they get into situations to where they want your entire banking experience. So they're going to want your merchant cards. They're going to want your payroll accounts. They're going to want whatever multiple accounts that you have, move them over. And a lot of, borrowers are oftentimes reluctant to do that. And we always say, when you do approach a lender, go to your lender you bank with now, first and foremost. We've seen some of you already use family and friends loans or assistance, but there's also some lenders out there, state guarantee lenders. And those are coming into play more so now that the U.S. Small Business Administration, with their SBA funding, is stopped making loans to immigrant businesses or those that are not 100% owned by U.S. citizens. So with that is coming into play these regional financial development companies in California, and mention that in just a little bit. So there's some online lending platforms generally associated with extraordinarily high interest rates, very easy to get. But the proof is in the pudding on those. Talked a little bit about the 401k borrower retirement funds. We've talked a little bit about invoice and accounts receivable financing. And related to that is purchase order financing. If you need to manufacture something, or if you need to actually maybe receive a government grant, for example, to whereas you're not going to get granted the funds, and potentially you can actually get money off of that in order to do some of the work. So we're working on a couple of cases like that. Equipment leasing is a very good viable option out there if you're looking to purchase a piece of equipment, and there are some good leasing terms out there. I've had some really good luck with borrowers clients that have used hard money, and has been a really good success. Again, it's going to be only on a real estate purchase, and it's going to take a large down payment to get that. The interest rate is not going to be cheap, but if you're getting a good deal on the real estate, it's well worth it in many cases. Credit card financing, a lot of really positive examples of that. Crowdfunding, lines of credit, joint ventures, bootstrapping, all these are great opportunities. CDBG, over-the-counter state funds, something really a lot of people don't know about. But there is an opportunity if you have a lot of time in order to do that. loans from financial services firms such as American Express. Sometimes your point of sale will do something where they'll do a revenue-based type of loan. Really, you got to look at the terms. On all those, you've got to look at the terms. And many times, they will not put an annual percentage rate. Everything should be judged on the annual percentage rate. And if it doesn't show the annual percentage rate, if you show me the terms, there's three variables that determine annual percentage rate, and two of them are going to be in that document. I can give you the third. I can determine the third out of that. And the third is going to be APR. So know your APR, please. I kind of can go off on that, so I didn't go into that too much today. So know your APR, but also there's a lot of specific industry. Sometimes it's best, and I'll use the example of trucking, whereas there are lenders out there that are in that particular industry that know it better than potential lenders and others. So look at some of the options that are out there with those particular sources. I had a client once that went into a truck stop and got a brochure. Came in, we called them, we looked at it, ended up getting funding from it. It was a pretty good deal. So those examples do exist out there, but it's a case-by-case basis. And really, on all these alternatives, some of them are going to fit for you and some of them aren't. You're going to like some of them, you're going to dislike most of them, because it's not just putting cash there, it's always doing something a little bit different. Okay, jumping into the alternative funding options. I'll give you kind of my top 6 and explain why I went with those decisions. Potentially some honorable mentions, but I think I could have just lumped those into my top 6 as well. But first, doing a good bit of research on this, I go, okay, what are the people that are going to attend this webinar? What are they going to do? What are they going to go into, say, AI and say, hey, AI, what are my top 6 alternative small business funding options? And so I assumed, I'll bet you a few of you have done that, or maybe more, maybe a lot. I don't know. So I wanted to see what they came up with and how many of those that I actually could actually relate to. And part of the reason of that is that I wanted to see if people were getting the right advice when they were going to AI. And so what did ChatGTP tell me when I put in the prompt? It told me basically that the number one is revenue-based financing. So revenue-based financing is going to be off of potentially your point of sale, if you're a service business, if you're a food business, or the other type business where they can document your revenue off of your deposits into that account. So that could also be many that don't own point of sale systems. It can be a lot of different options, but they're going to use the deposits off of your bank statements. They're going to use what's in your Square or Toast or whatever point of sale system you use or whatever. So some of the more common ones are Square and are some of the other fintech lenders such as OnDeck and so forth. Now, some of those models might work for some businesses that are experiencing high growth, need the money quickly. But for most, they don't, because most don't use those types of funds wisely, and they don't do the APR. If you do the annual percentage rate, and I get into this time and time again, whereas I think most of the borrowers that use these types of funds, and along with merchant cash advance, which I could not believe that they came up with number 2, and we kind of got a strange response from me. It's like, oh, come on, Chat, for sure, you're telling me that RBF and MCAs are the best way, the best alternatives you can come up with? I go, we call it vulture financing around here. And of course, they did mention that it's high interest rate and other things. So those were the number 2. Number 3, equipment financing and leasing. I cannot disagree with that. That's a good option. It's going to be available to the smallest people that have maybe a small mom and pop restaurant and you need a $10,000 or $15,000 piece of equipment all the way up. Again, like with every other funding, you're going to want to look at the terms and you're going to want to analyze and read the small print carefully. Their next one was a strategic equity partner. And, I don't know if that's Chat tapping into me a little bit, but I think Chat might have learned that I really enjoy strategic partnerships. And I really like the opportunities that they have, and I think that they're underutilized and underappreciated. Number five, chat told me, was CDFIs. I'll tell you right up front, I'm not going to disagree with that one. And I can't go too crazy wrong about the accounts receivable financing if you have the right person and you have the right project. And of course, with a lot of these projects, it's going to depend on what you're trying to finance. So my top six, and I'm going to start with number six, is going to be bootstrapping. I wrote up there, I love it, and you won't. And I pretty much have seen that throughout. But one thing I like about bootstrapping is, and basically bootstrapping is trying to create and preserve as much capital as you can. So you are living a frugal lifestyle if it's, say, a Main Street business. And if it's a tech-related business, you're not taking earlier investments. So if you have the opportunity to go out and get an investor, what you're doing is you're putting off as long as possible during your business process the ability that would end up diluting your capital or diluting the ownership of your business. But really, bootstrapping is something that takes some time and it is very difficult because it is tough to live on a very minimalistic point of view for a lot of individuals. It's not keeping up with the Joneses, it's staying as far away from the Joneses as possible. But what it does is it allows you to put all of your resources to that particular business and give it a great way to survive. So you're creating and you're preserving capital by bootstrapping. So rather than have these other two that I do like, I included this in number six. Other creative ways to create and preserve capital. You've heard us talk about crowdfunding. There are many other options other than the kickstarting option that we went through today. We'll be expanding on those with our student teams, our student AI teams, trying to figure out a way to make it as easy and profitable for our small business clients. But also, what we're looking for again is partial capital injection by preserving capital and using even a small amount of your 401k plan and setting it up properly. Setting it up properly so you don't incur the tax disaster, and also the other issues related with taking retirement funds out early. There is a way to do that. So number five, I'm going to go with the accounts receivable financing, and that's only going to work for those that basically, again, have business to business sales and business to credit, or excuse me, business to government. And so, again, oftentimes the credit history on that is going to be based on the person who you are invoicing. So I think a lot of times accounts receivable financing is not cheap. And I know you're saying, oh, sure, you badmouth the MCAs, but AR financing is more of a tool to get you to a particular high growth area to get to that point to where you get that credit line and get that line of credit or that term funding and get off of AR. And done right, it is a very good tool to use. Number four are the lower cost credit cards. Okay, I gave you a lot of really good reasons, and I know what you're saying here. You're saying, okay, credit cards. I came here today to listen to you talk about credit cards. Well, we sent a client over to one of our credit union lenders. I believe Alta One Credit Union. They have a 10.99 credit card. It goes up to like 15,000, and it's a line of credit if used properly. So if you're talking to me about needing $25,000 and you can get, you know, 15,000 of that at 10.99%, that's cheap capital in my point of view. And if it's used properly to where you borrow the money to use it in your business, and then when the money comes in, repay it, then what you're doing is you are effectively using it as a line of credit. So you might not get a bank line of credit, but by using that credit card and others potentially stacking those that can be dangerous, I realize, but there are ways to actually manage that potential aspect of your business. Okay, I can't get away from the strategic partnering and joint ventures. Uh, I've seen a few examples. I haven't seen any recently. That's maybe why I keep bringing it up. But strategic partnering is oftentimes funding, but it can not be non-funding to start with. So maybe you do start working with a larger company, and the larger company potentially you both have a mutual beneficial agreement. What you're doing in this partnership is benefiting your partner, and what they're doing is benefiting you. It is bringing more customers in that normally would not come in. And potentially doing that can lead down the road for strategic partnering funding options. Same thing with joint ventures, whereas, I'm not going to say I'm a big partnership guy, but oftentimes on a project that you can identify somebody to work with, joint ventures is a good way to go. Number two is CDBG over-the-counter funds. And I did mention this a little bit earlier. CDBG is the Community Development Block Grant Program for the state of California. They're federal funds that come to the state. And if you've got time, every one of these programs, have issues or have conditions that work for them and will make them work. So here, you need time and you need to be hiring individuals who are going to make low to moderate income. That brings in the community development block grant aspect of it, which is low income housing and also economic development for low to moderate individuals. So there is some bureaucracy involved. The state doesn't always have the over-the-counter funds, but I've seen it actually do a lodging property that couldn't get funded. And this was a bigger size project, but it was about a $3 million project. And they were able to use those funds to get going. And now they have 4 different resorts, and they are just kicking butt. 4 resorts, doing great. And it just got the foot in the door in order to get through to that next level and get you to that point. So smaller projects can do it. You're going to have job creation in here. You're going to have to basically work with Sacramento, and it's going to be a longer term project. It's going to take months, and it's going to be frustrating. But the interest rate can be low, and the funds can actually be used. And actually, the funds can go back to benefit whatever community you're in. And number one is going to be other bank lender options. So we saw CDFIs, and we know that CDFIs do not have the same qualifications. Presently, I think we've worked with probably in the last maybe 18 months, we've worked with maybe 6 or 8 different CDFIs. We have 2 CDFIs in Kern County, being Valley Strong Credit Union and Alta One Credit Union. There are 6 others that we have worked with, 6 or 7, I don't know. And we just really believe that the community development block grant or community development financial institutions, I love my acronyms, are a great way to go and a great way for a lot of different people. USDA has a lot of rural programs. Some of those are tied to agriculture. Many of them are not. And we're starting to see some of those come into play. They also have some rural smaller grants that for agribusinesses. But also, with this program, USDA will do a shopping center in a rural area that's under 50,000 people. So, there's a lot of flexibility with what they can do to enhance and build upon rural communities. And so the USDA rural agricultural programs, but really rural community development is really a great program. Some of the state lending options moving forward. We talked a little bit about the state financial development corporations of 7, which we see them as being far more active. That does take bank involvement, but it's going to be lesser qualifications and maybe more pointed. If you're more pointed and directed to the right program that helps you get financing, that's the way to go. And then, of course, I mentioned a little bit about hard money, but really some of the unique and oftentimes many bank programs that are out there. And I think we got a few more than 6 in today. And don't be afraid to have multiple sources. I like to throw this little formula up here. And all it is a formula to where if you have multiple sources of debt at multiple interest rates and terms, I can tell you what your actual weighted average cost of capital is. So if you get something in there like a credit card that's got 24%, and we get you something that has lower funding, that averages it back down based on the amounts of the loan and the interest rates. What you're looking at is you're looking at what's that average cost of capital for you. So don't be afraid of certain ones that are going to be higher than others if you have multiple funding sources in there. We have a lot of tools to help you get to this point and to try to work with you here. We've got some great consultants. We use LivePlan, which is we find to be a fantastic resource. We use Vertical IQ, which is really great for industry analysis. If a lender looks at your particular project, they were going to analyze your results compared to the industry. We have all that in Vertical IQ. We can do that before it gets to that lender. So that's a great tool that's available as well. Many of these will be referenced. I'll get Maureen the copy. Like for example, Webinar Wednesday 357. We're on 378 now, done last September, was the one on how you use retirement funds and actually set up a C corporation in order not to be charged an early payment withdrawal or taxes on that withdrawal. Costs some money to do it, costs some money to get that, but really it's a great source of your own money. So there's a lot of different resources out there that are for you. We want more on capital information. Our Eastern Sierra Capital Summit, save the date. It's July 16th in Mammoth Lakes, California. There's how to contact us for confidential, no cost obligation, free consulting. Go to csubsbdc.com. We'd love to hear from you and we'll try to help you through your particular situation. Again, thank you all of our business partners for helping us be here today. And there's how you contact me. So let's jump into some of the questions that we have and see if there's anything in the Q&A box. Don't see anything floating in Q&A, so let's hit the chat box, see what's going on in chat. And Maureen has been active in there with a lot of fun stuff. Let's see, she starts off with greetings and salutations. Boy, that's common, isn't it? And also then jumps into a lot of the on-demand links. You will get an email with today's copy of the webinar, a link to today's webinar, a lot of the resources that we talked about, and I think there will be a lot of resources. So you will be getting that in your inbox later this week. If you need to contact Jim Thomsen, there's him, and he is available as an SBDC advisor if you want to do a Kickstarter campaign. The cost to you is nothing. Sure, he cost me something, trust me. Okay, he doesn't cost me a dime. He costs the SBDC something. Well worth it, my friends. And there's the Kickstarter campaign for the Yosemite Film Festival and Storyteller Summit that's going to be in late June in Yosemite. Need help with an AI project? Shoot me something. We are working with a lot of people, food service businesses, restaurants, etc., really focusing on some really fun stuff right now that we're getting out of AI. Don't see any specific questions. No questions. Okay, well, let's go to the Q&A box. There we go. Okay. Can you tell us about CDFIs? So I think that's CDFIs. So community development financial institutions, they are regulated by the U.S. Department of Treasury, and they're nonprofit organizations or they're nonprofit arms of lenders. So they are a nonprofit, so their mission is to make easier small business loans. We have some of them we work with who will have a limit of $50,000 and they won't loan to you unless you've been in business for a year. And then there are others that welcome startups. So, welcome startups and will actually do a larger amount. So there is a lot of other unique things out there. There's a lot of unique programs that can help you. It's just really getting down and sitting down with your advisor and going through the options, going through, the strengths and weaknesses you're going to have in your application process. So that is it. So that's a little bit about CDFIs. We work with a number of them, mentioned a couple of them, but really great list and great individuals, different across the board. We like to refer into the ones that we think you have the best chance of succeeding with our SBDC team. Okay, next, are there any loans or grants for startups? Well, grants are becoming harder. If you're in particular spaces such as high tech, there's the SBIR program, the Small Business Innovation Research, that will do grants. But really, grants have gotten harder. But yes, there are loans. There are lenders that still do startup loans. But really, what you have to do is you really have to work on your financials. You have to have your financials down. You have to have them ready, and you have to understand what is in your numbers. Because every lender out there is going to be, to one extent or another, a cash flow lender. And that is going to be, they're going to lend based off of the cash that you generate in your business. So they want to see where you generate cash out of your business that can support the business, provide you an earning and a wage, and also repay them. And that's all it takes right there. That's the bottom line. So there are loans out there for startups. Okay, you've run over. Dang, how did I do that? Okay, so that is going to do it for today. I would like to thank my very good friend and actually guest today, even though he was live looking, he was in studio live looking with that great project, Jim Thomsen. So thank you, Jim, for being here. Going to follow your project the next couple of weeks as we move along and continue to do so. So thank you, everybody. Reach out. There's help out there. Reach out to us or someone else and get help. Have a great day, everyone. We'll see you next week. Bye bye.